All right, our next two are going to be private placement and securitization. So, private placements. Now, again, this does not mean the firm is private. They may be private or they could be public. This is where, like I said, the wording, I wish there was a different, like, I wish we didn't double use private here. I think it makes it kind of confusing, but we'll go with it. All right, so this was done by Regulation D, which was something that the SEC passed that basically made private placements legal, right? Because any kind of public security has to be registered with the SEC for it to just be traded in the general public. But Regulation D, they allow for these private placements. All right, so it says a provision in the Code of Federal Regulations that permits the sale of securities to accredited investors, so you can't just sell it to anyone, but places restrictions on the subsequent trading of those securities. So private placements are not going to have the liquidity that public, securities do, right? It's kind of like they're made to not be traded, but there's other benefits to them, okay? So we can have private placement of equity and we can have private placement of debt. Now, the biggest benefit to these is typically it's done quicker than a public offering. Because again, I have to go through so much scrutiny if I'm going to be selling things to the public because we want to protect the not so smart people in the economy. Protect them from themselves kind of thing when it comes to money. And so private placements get less scrutiny, and so they can be done quicker. They can often be done cheaper because they're quicker. Again, less scrutiny, and it also allows smaller companies to access capital markets easier. That maybe they wouldn't have such access to these markets if it wasn't for private placements. And honestly, private placements are used more than public placements because it's those same problems with the public placements of just the scrutiny and the time and the cost. It's just not worth it sometimes. So private placement of equity, it says when a public company sells shares of its stock, but here's how we get around it. So we can be a public company. We can do a private placement of the equity. It's actually called private placement of public equity. There's a missing word there. That sounds really weird, right? Private placement of public equity. Like, what? It's a public company, but they're going to privately place the equity. And it won't be able to be traded like the public securities are. And so the way they get, around this, or the little caveat here, is they sell it directly to an institutional investor. So these big management groups, these big funds, these big endowments, these are sophisticated institutions that know what they're doing. And so this allows me to sell just equity directly to them without having to go through the SEO process, basically. Cheaper, quicker, easier. And I get the same thing. I get to raise money. So that's all I care about as the firm. Now we can also do this with debt. So I can place debt privately, okay? And then, even if it's an unregistered security, what can happen is it can become a registered security after being placed. And then it can be traded just like normal. Yeah, try to figure out that one. It is Rule 144A, allows securities to be registered shortly after they have been issued, providing companies a quicker way to issue debt that ultimately will trade in public markets. And so then it gives it liquidity. So it starts off as being not liquid since it's a private placement, being placed directly with a qualified institutional buyer of the debt. But then after that, it can become a registered security and then traded freely among the market. So it starts off as private and then it turns into public. Finance gets a little too creative for its own good sometimes. That's when people start going to jail, when they get way too creative. Yeah, don't do that. Always found it weird. The previous university I was at, on the evaluation for the course, it would say, does the professor encourage you to be creative in your work? It's like, yeah, we don't want people to be creative in finance. That's when you go to jail in case you get too creative, right? Like, there's some fields you don't necessarily want creativity. Yeah. Okay. Anyways, that's private placements. So be careful. Private placements can occur in public firms. Public securities cannot be issued, though, by private firms. Whew. Next one here, securitization, our good old friend. All right, so securitization just means to turn something into a security, right? We think financial securities, standard definition there, a claim that is standardized and regulated by the government, aka a stock or bond. Right? The thing that makes financial securities unique is that standardization, right? And so I don't care that when I sell a share of Apple and then I change my mind and I want to buy it back the next day, I don't care if it's the same share or not, because it's a standard share of Apple, right? Just like if I go to the store and, you know, I trade one $5 bill for another $5 bill, I don't care. They're both $5 bills. There's a word for that. I can never remember it, but, you know, it's because it's a standard item. Now, mortgage is different, right? Like, I can have a mortgage and my neighbor can have a mortgage, and they can have completely different terms. They are not standardized. So the process of securitization makes things into a financial security, basically. And so things like junk bonds have become have gone through the process of securitization to become a financial security. Commercial paper has now been securitized. I guess that's a word, or I'm just going to make it up. Commercial paper has gone through the securitization process to where now it's standardized. And what happens with this is that you get liquidity, which we all know investors love. So securitization is the process whereby financial instruments that were previously thinly traded, or not really at all, or converted to a firm or to a, I should say form. I couldn't even figure that one out at first. To a form that creates greater liquidity. Also applies to the situation where specific assets are pledged as collateral for securities, thus creating our friend asset-backed securities. This was a bonus question on one of the exams, the first one, I think. Right, asset-backed securities, a new security that represents a claim on a specific portfolio of financial assets with our favorite friend that crashed the economy, our mortgage-backed securities, right? Whereas one mortgage is different than another mortgage, what securitization did is it bundled those mortgages together and then created a financial security based on the cash flows the mortgages provided. Right? And then it sold off those streams of cash flows to investors. And then those mortgage-backed securities could be freely traded. And we could rate them AAA because housing prices were never going to fall nationwide. And people would never just walk away from their houses on purpose because they didn't want them anymore. Because they were so underwater. And then we had those mortgage-backed securities that were rated AAA. Highest bond rating, right? As high as the U.S. government. Safest things in the market. We had those fail. Did anything happen to the rating agencies? No. If you haven't watched The Big Short, of course, you should be watching that. Like, there's basic finance movies every student should have watched over the past 5 years or so. Because it really does like bring a lot of these concepts together and show you them in action. And, you know, the 2007-2008 financial crisis was terrible. People lost their houses. People lost their jobs. It ruined people. But from a finance perspective, it's extremely interesting. I know that sounds terrible, right? But crises get studied. No one studies good times. No one's like, man, 2012 was just great. Let's go study it. No, people go back and study 2007, 2008. People are going to go back and study 2020. right? There will be a ton of case studies, not just in medicine, but there will be a ton of case studies that come out of the business world for 2020 and how some businesses were able to thrive and how some businesses failed. And then, I mean, you have the whole minimum wage, the labor market, that's going to be studied. The impact of giving people ridiculous amounts of stimulus checks. You know, there's going to be so many economic case studies and financial case studies and logistic case studies, business in general case studies. 2020 is not going to go away for a bit because we don't study good times. You study bad times. That's how you learn. All right, 2 more to go, and then we're finished with these alternative sources. And then we'll wrap up by talking about how and why a firm goes back private.